Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, hi everyone. So, we've got two things to do today. The first is just to finish up those last couple of commodities slides. Now, we finished this slide yesterday, but I listened to the recording and I was sort of halfway through a sentence when it all cut off. So, what I'm going to do is I'm just going to go through this slide quickly to get us up to date. Then I'll go through the last two slides and then we'll move into the assignment detail for the workshop. Now, remember, we said that when it came to what determines a commodity's futures price, there were two main theories. The first is the theory of storage, and that's what you did back in Foundations of Finance. It's not a big focus of this course. What we focus on in this course is Keynes's theory of normal backwardation. And the reason that we focus on it is that it isn't a no arbitrage argument like the theory of storage. It actually allows for things, for what we call a risk premium to be earned because of an imbalance between speculators and hedgers. And it's that risk premium that helps us to understand why commodity returns have been strong in the past. And it also helps us to understand why commodity returns may not continue to be strong in the future. So remember, what Keynes said is that there were more hedgers than speculators in commodities. Now remember, hedgers are what, typically? Consumers or producers? I probably got it there, doesn't matter. Got it there. Hedgers are typically producers of the commodities. Speculators are consumers. And remember, when we talk about portfolio construction and we want to invest in commodities via futures, we are investing in long positions, which means that we are taking on the role of speculators on the consumer side. So we have a lot of hedgers that are producers. We have far less speculators that are consumers. So we have a lot of people wanting to go short, far less people wanting to go long in commodities markets. So what Keynes then said is what the producers that want to go short say to the speculators who are willing to go long is they say, look, we understand that we need to persuade you to take on the long side of our contract. We want to get rid of our risk. Let us compensate you by taking the futures price. And remember, the futures price is what the speculators pay. They don't want to pay a lot, right? Let's take the futures price and bring it below the expected future spot price. That way, you get to purchase at a lower locked-in price than what you expect the spot price to be at maturity. Because in that case, what you expect to do is profit, right? You lock in a low price to pay of F. You get to sell it at the spot price in the market at the time, which you expect to be higher than the locked-in price. Right? So the speculators that are taking long positions expect to profit. And in return, they take away the hedging producer's risk. Right, so that's why we have a futures price below what we expect the spot price to be. It's because the speculators have the bargaining power. The hedgers are willing to drop the futures price down because it means that they can hedge away the risk of their production, of changes in the price of the good. Most of the time, we are in a normal backwardation market. Occasionally, the market will move over to contango. It's typically times where consumers are really hurting due to things like price hikes, right? So I said in 2005, we had the Iraq War, we had Hurricane Katrina, and as a result, the price of crude oil kept rising. Now, if you're a consumer of crude oil, that's obviously damaging you. You're paying higher and higher prices. When market forces like that occur, it can flip the market into contango, where the majority of people wanting to hedge price risk aren't the producers, because they're just getting high prices. That's great. It's the consumers, because they're having to pay more and more, so now they want to hedge to get rid of their own price risk. So when that happens, it's the hedging consumers that are in the majority, and the people willing to go short are in the minority. So the ones willing to go short are the ones with the bargaining power over the price, right? So now the consumers wanting to go long persuade people to go short by doing what to the futures price? What's going to happen? If you go short, you're going to have to pay F, so do you want that to be high or low? Yeah? You've got to pay F? No, I think you were right. Low, yeah, right? So what you do is you adjust the futures price. Wait, let me do this right. What are the oh, I love it when I do this. Okay, so you are a short position, you are going to lock in a price you receive. That's what I did wrong. Okay, you're short, so you're receiving it. So obviously what you want to receive as much as you possibly can. So in order for the long position to persuade the short position to take the contract, they bring F up above the expected future spot price. Because then the people in the short position are expecting that they will receive more F than what they expect the price to be in the market at maturity. So it's all about the imbalance between supply and demand. And the longer the time to maturity, the more uncertainty over the price, and therefore the bigger the gap between the futures price and the expected future spot price. Okay, so that was what has historically been the case, and because we're normally in a normal backwardation market, it's been really great for the speculators getting to be persuaded to take the long position by that drop down of the futures price. But as commodities investing became more and more popular, we have all of these hedging producers. We didn't used to have many speculators. We're having more and more speculators come into the market. So that's more and more people willing to take long positions, which means their bargaining power is dropping, and with it the risk premium that's being earned. Right, so the idea behind the financializations of commodities is that as more and more speculators willing to go long come into the market, it will potentially eat away at that backwardation risk premium. And as we're going to see on the last slide, if you look at commodity returns over the full time series, and then you bring the start date closer and closer to today, you can see that the returns to commodities are being eroded over time. They're smaller now on average than what they used to be. Okay, so now that we have looked at the different ways you can get a commodity return, you can link that directly into the drivers of commodity returns if you want to invest as an asset class. One of them is interest rates because of the return on collateral. Now this one only applies to one avenue for investment. What would it be? Have a look at the two equations. We're talking about changes in interest rates which affect the return on the collateral. So would it affect physical commodities or CCFs? CCFs. Okay, so when you learn them, when you learn the drivers, remember the driver of fluctuations in interest rates applies to CCFs in particular. The next two do apply to them both. The first is the unexpected change in the spot price. Right, that might be because of a supply or demand imbalance in a physical commodities market. Perhaps there's a big virus that wipes out a large proportion of the supply of sheep, which therefore reduces the supply of wool. Perhaps there is a big boom in the demand for gold. Right? Whatever it is, its changes in the supply and demand is going to shift the price accordingly. It might be affected by macro drivers like the economy and inflation. And it's going to be affected by investment demand through things like the financialization of commodities that we just spoke about. The third one is the risk premium. And sorry, let me rephrase what I just said. The first and the third apply to collateralized commodities futures funds. The second applies to both CCS and a physical investment in the commodity. Obviously, the risk premium only applies to CCFs because it's all about the difference between the futures price and the expected future spot price. If you're not investing in futures, then your returns aren't going to be affected by this risk premium that's part of the theory of normal backwardation. Okay, now remember, this all comes down to the balance of hedgers and speculators. And because of the financialization of commodities, we have more speculators than we used to. That is reducing the imbalance between hedgers and speculators and eating away at the backwardation risk premium. So to see how the financialization of commodities is reducing the returns, I wanted to finish with this historical time series of the Goldman Sachs Commodities Index. Now, the Goldman Sachs Commodities Index has three different ways of looking at, three different ways of quoting the time series, and they report in different ways. They've got a total return index, an excess return index, and a spot index. So I've got all three of them here. Don't worry about the relative difference between them because they're calculated in very specific ways in terms of the rolling over of contracts. What I want you to do is have a look at the way that, if you look at this table, the time period is shortening closer and closer to today as you go down. Right, we start with the full period from 69 to 15, then we shorten it 85 to 15, 95 to 15, 05 to 15, and 2010 to 2015. And every time we bring that sample period closer to today, you can see that the returns to commodities are diminishing, and by the end, they're actually turning negative. Right, so that, although commodities in the past have provided a very strong return, with very good diversification potential and an inflation hedge, it's not guaranteed that that's going to continue in the future. Any questions on the lecture? All right, so I've just said when you look at the examinable reading for next week, the Russell report on the hedge ratio is a really good reading to look at before you go into the lecture, because it gives you quite an intuitive interpretation of the types of things you consider when you want to decide how much to put in world equities hedged versus unhedged. Next week is our global investing and currency hedging week, which is one of the few mathematical parts of the whole course. So you can be pretty sure that you're going to get a numerical question to do with next week at the very least in the exam. All right, so if we go into the workshop, I actually haven't had that many questions this week compared to last week. So we may well have time at the end, in which case if you have any other questions, you're welcome to ask them. But what I wanted to do is to go through an example process step by step of how to derive recommended weights. It's not one that you have to follow, but it's one that ties in nicely to the steps that your clients have asked in terms of first doing quantitative analysis and then moving into qualitative adjustments. I also wanted to talk a little bit about the qualitative elements of the assignment. I can't really give you examples here because the examples would have to be tied to the clients, and in doing so I'd give you potential solutions that would limit your thinking. So what I want to do instead is just talk a little bit about the types of things you might want to consider in terms of bringing together the course material, considering the fundamental risk approach, how easy it is to implement the investment, and so on. And then we've got a couple of questions prompted by student queries, in particular relating to that really annoying shortfall constraint relative to the peer group that you have for Robert, which is very hard to word. So I wanted to give you an Excel example of how you'd measure it in different ways. Okay, so let's start with the process of deriving your recommended weights. Remember, the goal of the assignment is to decide a recommended portfolio, one for each client. And remember, they shouldn't be the same because the clients have very different objectives and constraints and they have different attitudes to risk. So this is a process that you would follow first for one client and then for the second. You're going to start by using quantitative analysis. You're then going to make adjustments to the output from the quantitative stage using qualitative considerations. Through those adjustments, you're going to end up with a final recommended set of weights. And you need to show how those weights perform against the objectives and constraints of the client. So what that means is after you've done your qualitative adjustments and you have your final asset allocation, you need to plug that back into your quantitative model to give you the output measures that you will compare to the objectives and constraints. So you start and finish with the quantitative model, and then you tweak the weights in between. So it's entirely up to you the exact steps that you take, as long as you do conform to what the clients have asked really broadly, that you first do a quantitative analysis and you then do qualitative adjustments. But I expect each group will do their quantitative analysis in slightly different ways, and they're going to have different subjective tweaks as well. But very broadly, this is one way that you could go about it. You would start with the quantitative model, and that's what the clients have asked you to do. That quantitative model might be a yearly bootstrap, it might be a quarterly hypothetical rolling portfolio. You're obviously going to do things like adjust the returns to meet the client's expectations. And once you've adjusted the returns, you need to come up with your initial quantitative set of weights. The goal of this is to find the set of weights that best meets the client's objectives and constraints based on the numbers. Now, I'm guessing the majority of you will probably do this using Solver, because the benefit is you can program in all of the different objectives and constraints and hit run. If you do use Solver, remember it can be unstable. So it might be that if you have one initial set of weights and hit Solver, Solver doesn't come up with a solution. But if you start with another initial set of weights, it might find a solution. Or it might find two different solutions depending on what initial set of weights that you start with. That's just one of the frustrations of optimization. So I do suggest that you run Solver a couple of times just to check that your recommended asset allocation is coming through consistently. If you don't want to use Solver, you could actually subjectively change the numbers yourself. It does take a lot longer, because what you need to do is you need to start with an initial portfolio that seems sensible and then make a tweak and see whether that makes the output based on the numbers look better. And if it does look better, you stick with that and you try to improve it again. If it doesn't improve it, you need to go back and try a new change. It takes a lot more time. A benefit of it is that you can bring in qualitative considerations as you go, so you're less likely to end up with a corner solution. But given that you have to have qualitative considerations anyway as your second step, it would be time-saving to start with Solver, unless you have a strong preference not to. And it really doesn't matter, it might take you days to tweak under the portfolio analysis workhorse method. All right, so what you have then is you have an asset allocation that will give you the best possible numbers, right? Only based on the numbers, given the client's objectives and constraints. But remember, we said that numbers aren't enough because they can often miss risks that can't be captured by your surface measures, and the data can be vulnerable to errors like selection bias and survivorship bias in the case of things like hedge funds, by appraisal-based valuation smoothing returns. So your first step is to say, what is the best asset allocation only looking at the numbers? The second step is, well, how do I improve that with my own reasoning? And that's your subjective adjustments. Now, in this, your goal is to find a better portfolio. By better, I mean better for the client. I don't mean better numerically. Because the really frustrating thing is because Solver has, by very definition, given you an asset allocation that will make the numerical output as good as possible, the second you adjust those weights, the numerical output will go down. It will become less attractive. But that's not necessarily a bad thing as long as you are still meeting the client's broad objectives and constraints, right? Because at the end of the day, you've changed those numbers because you've said that the numbers don't capture everything. Now, you don't want to make so many tweaks that you don't meet any of the objectives and constraints, right? If you do that, you've gone too far. You've focused on the qualitative and lost the quantitative. But what you want to do is you want to make adjustments at the margin to bring in some of the considerations that Solver can't do for you, right? If you think the weight on direct property is too high, because the data is smoothing the returns and understating the risk, you might want to tweak the direct property weight down. If you think that your portfolio is exposed to a particular fundamental risk, right, because remember, Solver doesn't know how to incorporate the fundamental risk approach, then you might want to tweak your asset allocation at the margin to reduce your exposure to that particular fundamental risk. If Solver has put a high weight on an asset class that you think is too difficult to implement, either at all or to that extent, you might want to bring that down. Right? If Solver has put a very large weight on an asset class and you think it's a corner solution, you might want to adjust it. These are all tweaks at the margin, and yes, they're going to make your final output, be it the return or the risk, look slightly less desirable, but as long as you meet the objectives and constraints, you're still fine. So you want to keep going, making adjustments through your reasoning, and you're going to be outlining the reasoning in the report until you settle on a final set of weightings that both meets the quantitative objectives and constraints, but also provides a more holistically appropriate portfolio for the client, where you've also acknowledged the qualitative aspects that can't be calculated from a computer alone. Does that make sense? Is there any questions about it? Now, do you mean the expected returns? No, no, that's a good point. No, so I've given you the expected returns to use. Here we go. So I've given you these expected return assumptions. You can use them as they are. You should use them, but you don't need to justify why they are the size that they are. Your client has given them to you. They expect you to use them, but you don't need to come up with a justification for their size because they've been given to you. Any other questions?
So this expected return is yearly?
Yearly. Yeah, so and if you have a look at the workshop video last week, I think, remember when it comes to quarterly analysis, you'll need to adjust them to a quarterly figure. Any other questions? So once you've gone through that process, you obviously then need to report your final recommended asset allocations, right? One for Abigail, one for Robert. You need to report the portfolio measures at those weightings, right, from your quantitative model, and explain the recommendation in the report. Now, do report every quantitative output, even if you don't meet the objective and constraints. Right, what tends to happen is every so often a group will meet almost every objectives and constraints, but miss one, and then there's a temptation to remove it from the report like it never existed. That's not right. The second your client sees that, they're going to think that you either ignored one of the things they asked, or you think they're too dumb to realize that you didn't include it. Right? If you haven't met an objective and constraint, you need to report the number, and more than that, you need to draw attention to it, and then justify why you are arguing the portfolio that you recommend is still acceptable, despite violating that objective. Now, if it's something like a tracking error and you're 0.1% out, right, that is fine. But don't, if the tracking error constraint is, if you want to check with me what's reasonable, by the way, you're welcome to do so. But if we have a look at an example here, use your common sense because, for example, where's my tracking error? Right, so Abigail has asked that the tracking error of the portfolio versus the peer group is no more than 1.5% per annum. If you give a tracking error of 2% per annum, that's actually a really big violation. I know it's only 0.5%, but tracking errors are small. So the difference between a 1.5 and a 2% tracking error is really large. Whereas if it's, 1.52, okay, that's fine. So if you are uncertain, by all means, send me an email, come and see me, chat to me about it in consultation, but really it's all about common sense. And if you do violate it, one of the things we'll just be looking at is how reasonable that is. whether you've drawn attention to it and whether you've justified it. Now, I said before that if you want to, you could choose to do more than one quantitative method for a single client. Let me emphasize again, you don't have to. The assignment only requires you to do one. The reason I've left this flexibility in is that some groups, I know in the past, and I've actually seen this time too, do want to do more than one. They want to see whether their allocation is sensitive to the method. And remember, I said in a prior week, if you do that, it may earn extra marks at the margin, but only if you do it well, right? It's not automatic that extra work means extra marks, because it's all about whether it adds value, whether it's written well, whether you haven't spent too much time doing things that haven't been asked, that you've lost the space you needed to do the things that were asked, right? If you do an extra method that wasn't asked and then you forget the overview of new asset classes, that's actually going to hurt your mark, not help it. So it is a balancing act, but if done well, it can be valuable, right? Because remember, these things are sensitive to your assumptions and your model. So what I know some groups are looking at doing is they're looking at whether they should, for example, for Robert, do a yearly bootstrap and a quarterly rolling method. Now the challenge there is, well, the chances are I'm going to have a different asset allocation at the quant stage if I use Solver for the two different methods. So what do I do then? How do I end up at a final asset allocation? And once I do, what figures do I actually report? So this section will not relate to everyone. It only relates to the people that do want to do more than one method for the client. But if you do, and remember, please, if you do, you've got to keep your writing very tight. You've still got to put all of the emphasis on the other things that they've actually asked for. Then it's all about strategy and how you combine the two methods to have a more robust allocation. So it's likely that the two methods are going to give you different recommended portfolio weightings if you're running them under Solver. You need to outline everything you do. So if you do more than one method, you need to outline them both, and you need to include both methods in your Excel file. Don't say that you do any quantitative analysis that isn't reflected in Excel, because we need to see the evidence of it. But you're going to have to come to one final asset allocation for each client, right? Don't report more than one option. They need to know exactly what to follow. And along that line as well, don't report a range. Don't suggest that they have equity between 30 and 35%. They don't want to think about what to do within that band. They want to be told what allocation to target. Okay, so it's up to you if you're going to do this, how exactly you're going to go about it. There isn't a wrong way to do it. But it's all got to be about how it's best communicated in a way that doesn't waste too much space and is clear. So one thing that you might do is you might start with two separate optimal quantitative stage portfolios using Solver, right? So you do a yearly bootstrap from Solver, you do a quarterly hypothetical rolling analysis from Solver, and it's going to give you two different asset allocation weights for your client. You might look at those two asset allocation weights and use your qualitative considerations to look at whether one is more reasonable than the other, or whether it should be a mix of them. That might get you to your recommended set of weights. Or you might want to have two different potential weights, average them, and then apply your subjective considerations to those. An alternative that I quite like is, let's say you've got one set of weights from quarterly analysis and one set of weights from your yearly bootstrap. Take your quarterly weights, plug them into your yearly bootstrap, and see whether the objectives and constraints are met under both methods. If they are, that's a good sign. Do the same thing for the yearly weights, plug them into your quarterly method, and see whether objectives and constraints are met under each. If one set of weights meets your objectives and constraints under both models, then you have greater confidence that that recommended set of weights is well justified and sensible. Right, so that's another method. Again, you don't need to do any of these if you're only going to do one quantitative analysis method per client. But no matter what, if you are going to use two different quantitative methods, you're going to have one final asset allocation, but that one set of weights will probably have different output figures under the two models. When that's the case, you might choose to report the output for both, or you might choose to report an average, or you might choose to say, we've looked at this second model as an additional consideration, but we are focusing on this other quantitative model, right? You might look at a quarterly analysis for extra robustness, but your main model is the yearly bootstrap, and you're going to justify why that's a better model to focus on and report the output measures from that. Right, so these are all decisions that you can make. Any questions on that part? Okay, so a couple of things about the qualitative elements of the assignment. And remember, this isn't something that I can tell you specifically what to do. One, because it will depend on what your allocation is. And two, I don't want to tell you what to say. I want you to have the flexibility and freedom to come up with your own ideas. But in terms of where you're going to come up with those ideas, the first thing to consider is try to bring together material from right through the course. Right? Think of it as like an exam question where you need to combine material from different weeks together, except you've only got one question and you know what it is ahead of time. So when you might choose to wait until you have your quantitative output, have a look at it, and then say, okay, well, for Robert, let me go back over the course materials and see what I can apply to Robert's case as an appropriate subjective change. And then you do the same thing to Abigail. In some cases, the same subjective tweak will be appropriate for both. That's more likely to be the case in areas where it's an issue with the data, for example, because it's an issue with the data irrespective of the client. So things like appraisal valuation causing smoothing of returns, that will happen irrespective of whether you are Robert or Abigail. Other things like key fundamental risk exposures might change depending on the client based on what the key exposures are in the output from the quantitative stage. They have different views on risk. They have different preferences on assets. So because of those reasons, you might again have different qualitative tweaks to their portfolio to get something that suits their needs specifically. Now, when you make the changes in your report, you need to be really clear what you changed, by how much, and why. So that's why I've worded the assignment in this way this time. Because what I sometimes see or saw in the past is people say, we did a quantitative method, then we changed the weights, and here is our final weight, but they don't show the initial set, and they don't say how much they changed the weights by. So it's actually very difficult to follow the method. You need to say, this is my initial quantitative, this is the weights from the quantitative stage. I then made these specific adjustments. This was the size of the adjustment and the reasoning. This is the final recommended set of weights. And this is how those final weights satisfy the objectives and constraints. Right, so make sure each step is clearly outlined so the client can follow the steps that you took, and your marker can as well. When you do look at your different subjective tweaks, remember that not too hard to manage is one of the objectives and constraints. Remember, they don't want to spend a lot of time managing their portfolio themselves. They're willing to pay for help, but only if there's net benefit. So that means that there's a couple of things to remember when you recommend a strategy for them. Don't recommend a strategy that they need to be constantly monitoring and changing. So, for example, I would caution against recommending to them that they implement a value-added direct property investment through a property syndicate where they're always monitoring the assets, right? Because they told you they want it to be not too hard to manage. But they've also said they're only willing to pay for help, managers, for example, where there's net benefit. So if you're looking at something like Australian equities, well, we've said in particular that Australian small caps, for example, do have good scope for alpha, right? The average small cap active Australian equity manager does well. So when you advise on how to implement an Australian equity investment, it's fine to recommend an active manager because you can argue that they do add value after fees. But if you recommend a global equity investment with a concentration in US markets, it wouldn't make as much sense. And what we're going to talk about next week when we look at global investing is the second you go global, there are a lot more challenges that you need to overcome. You either need to overcome them yourself, which would fall into the not too hard to manage, or you need to pay someone money to overcome them when you want to be active in global investment in equities. So when it comes to your world equity investment, based on what we're going to talk about next week, when you write up how to implement the investment, maybe consider a passive strategy, for example. You don't have to, but if you consider an active strategy, you need to acknowledge that there is higher fees, so then you need to think about whether the performance is worth it. But a lot of the challenges of a global investment strategy can be overcome if you go passive. Because, for example, you can buy a global ETF just by trading on the ASX, right? BlackRock have a series of iShares where you can get a passive investment on a world equity fund, it's an ETF, but you're still trading over the Australian exchange. Right, so even though it's a qualitative constraint, don't leave it out. And when it comes to things like not too hard to manage and is there net benefit, particularly when it comes to alternatives, remember what we've said about different alternative asset classes having issues with manager selection and manager access, and we often look at performance as well. It doesn't necessarily rule any of them out, but they're important things to actually acknowledge when it comes to your report. Now, in addition to sort of synthesizing materials that we've looked at through the lectures, another way to look at subjective changes to your asset allocation is the fundamental risk approach. Right, so you might start with Solver to get your quantitative weights, and then as part of your qualitative changes to the weights, you might want to look at the two papers on which the fundamental risk approach is based, and they're listed under references at the bottom here. Have a look at those and look at your portfolios and say, is there any big exposures, like an overexposure to the profit share, that mean that we should take some weight away from a particular asset class and give it to another one, ideally without sacrificing expected return. Remember, if possible with the fundamental risk approach, the changes at the margin should keep return fairly similar while reducing exposure to that specific fundamental risk. It's not always possible, and it's particularly challenging for you guys because neither Abigail nor Robert can leverage, right? Because remember, with the fundamental risk approach, if you can leverage, you can switch into an asset with a lower return and a lower exposure to that fundamental risk, and then leverage to get your return back up. You can't do that in the assignment. So chances are a lot of you will make changes based on the fundamental risk approach that will bring your return down. That's fine because they can't leverage, but just acknowledge that fact. And if you do think that there's a switch that will keep expected return at similar levels, then you should have a priority on that switch. So think about the risks that matter most to your client as an individual. Do they have any concentrated fundamental exposures? And if they do, how do the asset classes relate to those exposures? And therefore, what switches can I do to start to reduce them? That's going to therefore tell you some tweaks to your portfolio. You want to identify them and talk about the effect on the numbers. Once you've done the switch, you check the numbers, check that you still meet objectives and constraints. If you make a major change based on or even a small change based on the fundamental risk approach, but you don't meet your objectives and constraints anymore, remember again, you've lost the quantitative focus and only focused on the qualitative. You need to balance the two. So, I mean, I think I've said before, often what makes the difference between a very good and a great assignment is the qualitative adjustment stage. And some of the best papers I've seen, the best reports I've seen, haven't just focused on one type of adjustment, right? They've brought in difficulty to implement, they've brought in data issues, they've brought in the fundamental risk approach, and they've tailored them specifically to the client and provided reasoning for it. And whenever you use an argument that isn't from the lectures or class, remember you need to provide a source. So, for example, I've seen some amazing reports that have looked at what inflation is doing over time, looked at macroeconomic variables, and have provided all this argument into their report. But they haven't cited the data source, which means it loses all credibility. right? If you're going to take data from the OECD or from FRED2 or from the RBA, make sure you always cite it and include it in your list of references, because your markers are going to be sitting there checking all of the in-text Harvard referencing and cross-checking it against your list of references. And if they don't match up, it is going to cost you marks, right? This is all of these things are the reason that you want to leave a few days before the due date to go through and edit and check for consistency, check for correct referencing, and so on. Any questions on that part? All right, so I'm going to go through this particular constraint, and then if we have time, I want to mention one other thing to do with presentation and graphs. If I don't have time, I'll do it next week. But I think I will, because this is actually a very simple constraint to do. It's just really hard to word. And so without fail, there are people that go, I don't know what you're trying to get me to calculate here. And it's probably because it's written in a way that makes sense in my head, but it doesn't mean it makes sense in yours. Right? Essentially, all this is like calculating probability of loss, but instead you're calculating the probability of loss relative to your peer group, and you don't define loss as any underperformance, you define loss as a significant underperformance. So in other words, and this is only for Robert wants to limit the chance of his portfolio value 6 years from now being 12% below the value of the comparison group, right? So his gauge for what he considers an unacceptable loss is his portfolio being 12% below the comparison group portfolio. So that's what he defines as a loss. He wants the risk of that happening to be no more than a 10% probability. So the 10% is the probability, the 12% is the parameter that defines the unacceptable loss. And unacceptable, I don't mean completely unacceptable, I mean a very low probability of it occurring. So there's 3 different ways that you can calculate it. I don't mind which you do. The first 2 will give you an identical answer, the second will give you a slightly different answer, but in the assignment it's worded as approximately 2%. I'm not really fussed either way. I'm guessing you'll choose method A or B because in most cases, based on the data, that's actually going to give you a slightly more attractive outcome, which obviously you want. But you can essentially apply the rule that no more than 10% of your observations are below any of the cutoffs here. Right, so we're going to calculate this using a data-based method, which makes sense because the normal violations that the normal distribution assumptions that you'd need for a parametric method are violated with the data that we're using. And remember, with a data-based method, all you need to do to calculate probability is count the number of times it's violated and divide it by the total observations in the series. So let's first look at yearly data. This is a bootstrap. There's no recommended allocation here, right? Robert's adjusted portfolio, I've just left exactly the same as his existing portfolio. But we've run the bootstrap. We have his adjusted portfolio figures for 6 years and a comparison group. What we're going to do is we're going to make sure that there is no more than a 10% probability that either, the first one is the ratio of values, the ratio of Robert's portfolio value divided by the comparison group's value 6 years from now. We want no more than 10% of the observations to be less than 0.88. That's the first one. So what we do is we calculate the value of your recommended portfolio for Robert. You divide it by the comparison group's value 6 years from now. And we want no more than 10% of these observations to be less than 0.88. Right? So you're just saying count if these are less than 0.88 divided by the total count. And you want the answer to be no more than 10%. Alternatively, you could convert that into a 6-year return by taking end value and subtracting 1, right? Because we've based it at a $1 start. And if that's the case, your 6-year relative return between Robert and the comparison group, you want no more than a 10% chance of that relative return being less than negative 12%. So you have your 6-year difference in returns based off relative value. You want no more than 10% of all of these observations to be under negative 12%. So for example, this observation here, negative 19.14, that would be one of your violations. Or you could just base it on an approximation. This is a 6-year return, so you can calculate, you can convert it into a 1-year annualized difference, and then you'd want no more than 10% of those observations to be less than negative 2%. Okay, so it doesn't matter which you use. These two will give you the exact same answer if you want to check your calculation. This will be ever so slightly different. I don't mind. They're all acceptable based on the wording that was provided in the assignment. You could also just literally subtract one return from the other, but I've played around with it, and typically based on this data, that will actually give you a higher probability of loss, which isn't really what you want. So these three methods will give you, they're accurate methods that will give you they won't overstate the probability of loss, which means that you're less likely to violate the condition. Quarterly data, you can do the exact same thing. The analysis is obviously set up differently. This is what I showed you guys last week. Right, here you might look at the ratio of Robert's value divided by the comparison group. And again, you want no more than 10% of those observations to be less than 0.88. Right, that's your benchmark, or your figure to focus on. Or you could calculate a 6-year, or in this case, a 1-year equivalent value, right? This one is the same as this one under the yearly bootstrap. And if it's an annual value, you would want no more than 10% of these observations to be less than this number here. So remember, to calculate the probabilities, you're just using your count functions. You say it's equal to count if the observations are below your required value divided by the total count of observations. Any questions on that? No, in this case, you don't. So using the compounded value will understate your risk measures when you're focusing on things like standard deviation. In this case, because the constraint is worded as a relative value at the end of year 6. So no, in this case it's okay, because the way you're... So the question was, does compounded values understate the risk of this constraint? The answer is no, because it's consistent with the way your clients have worded it, whereas your standard deviation and your tracking error constraints are expressed as yearly values, right? It's based on yearly returns, whereas this is worded in a way that's based on the value after 6 years. Any other questions? Now, the other thing I wanted to talk about today is something to remember to do with presentation. I'm going to talk about presentation more next week. By the way, even the one I'm saying is the best of these three isn't perfect because the color scheme is pretty crap, but I want to start you guys, because I know some of you are starting to think about the write-up, start to think not just of what to write, but how to write it. The first thing is, when it comes to asset allocation, it doesn't really work as bar graphs, it works as pie charts, because you're taking a bucket of money and splitting it up between the different asset classes. Right, so it really does make sense to show a recommended asset allocation on a pie chart. I've just used the peer group weights here. There's 3 different versions. The first thing I'll say is, you guys are submitting this electronically. You're not printing it. So you have no excuse for providing me a report in black and white. I know there is a book called 50 Shades of Grey. I can't distinguish 8 shades of grey on a pie chart, okay? So please don't make your visuals in particular black and white, because, all right, I've got 1, 2, 3, 4 breakdowns there, and even then I'm starting to squint. My eyesight isn't great. It might be that your markers' eyesights are a bit better than mine, but we're all looking at it together and we don't want to squint. And for the same reason, don't make your font sizes too small either. Okay, so the first thing is, Don't have it in greys, have it in colour. Now, these are just the colours that Excel gives you by default. If you have a colour scheme for your firm, put your tables in that colour and put your pie charts in that colour. Make it look like a professional, cohesive piece. Up here, we do have different colours, but the second question is, what if one or more of your clients is colourblind and you won't know it?